Beautiful. All right, guys. Good morning. Thanks for coming. Can everybody see the screen? Yes. All right. Awesome. So we're going to start off with a familiar screen, right? Good old risk disclosure. Enswell Capital LLC, referred to as EWC, is not licensed to give financial advice. The following presentation is a replay of ideas and concept used by EWC. Trading futures, foreign currency, and options involves substantial risk and is not suitable for every investor. An investor could potentially lose all or more than their initial investment. Risk capital, defined as money that can be lost without jeopardizing one's financial security or lifestyle, should be used for trading, and only those with sufficient risk capital should consider such activities. Past performance does not necessarily, is not necessarily indicative of future results. So trade at your own risk. So what that means is I do not have a Series 63. I am not a financial advisor. I trade my own money. Um, and quite frankly, I'm not really sure why you would want to be a Series 63 financial advisor. You don't get the pay structure that you do when you run funds. It's a little bit of a disadvantage. All right, so here is the topic for today, right? Timing the market. Who am I? My background in the markets I trade. The most important chart in trading. It's going to be a good one. Applying distribution to technical analysis. Variance risk premium, IV versus RV and HV, which is implied vol versus realized vol and historical vol. Implied vol and skew, the VVIX and the VIX. Premium skew versus vol skew. What is the market telling us? High of day, low of day versus time of day. When does the market move? Spot gamma's trace and the most potent signals. Reacting, not predicting. How to trade zero DT, right? How to trade zero DTE properly. Strike selection and rolling. And last but not least, journaling and the importance of keeping the score. All right. So just a heads up that these are advanced concepts. And the good news is that if you're a new trader, I just saved you hundreds of hours of searching for the right stuff to watch because YouTube is full of education. And if I told you that the answer was there amongst a million videos, how long would it take you to find the needle in the haystack, right? So next, we're going to touch on the topics that we must comprehend in order to understand the walkthroughs of the trading sessions later in the presentation. These concepts are the foundation of how I manage risk during trading sessions. So the way I'm going to run this presentation is I'm going to begin with crucial concepts and education that will enable you to fully understand my breakdown of recent trading sessions and how I navigated those sessions. And in one instance, how I made about 500% in gains on a single trade, right? That's on a single position in one day, using these concepts to stay abreast of changing market dynamics. All right. And it was a little bit of a tricky day as well. So, all right. My background. I spent my entire life uh, going to work with my dad and my uncle and my cousins. I wanted to be a trader since I was a young man. My father was a local on the NYMEX crude pit for 30 years. My uncle was a broker on the COMEX gold pit. I interned for MBF clearing during summers as a teenager, and I began trading the day I turned 18. I worked at the New York Mercantile Exchange from 2002 to 2007. I traded crude oil and bonds from the desk and phone in 2002 to 2004. So if I wanted to place a trade, I had to pick up the phone, call the front desk and say, hey, I want to buy 10 lots of crude oil at the market, and please put a stop at 25.80. And so I time stamp my card. They call me back and say, hey, Steve, you're filled at even and your stop is at 29.80. And then I stamp the card again. And that's how long it would take you to get a fill. All right. So I transitioned. I was actually working for my dad, and you know how that could go. So I actually was fired, LOL. And I transitioned into E-mini Futures natural gas pit working for Mark Fisher and MBF Clearing, who was the clearing firm that handled all the traders on that floor. And I was doing electronic arbitrage. So really, probably one of the original E-mini traders, there was no volume, and they had us stationed outside of the pit. And so our job was to provide liquidity to the E-mini product. And then let's just say that the E-minis were offered at 5, right? But the pit was offered at 9. I could go ahead and hit that offer and then arbitrage it in the pit. Just run on down, hand them an order ticket, and get filled real quick, and then come back up to my station, which was hovering above the pit. So I got to watch over the pit and use that as my indicator. Okay. I drew my chart. I had a piece of graph paper, and I drew my chart by hand, a bar chart. No moving averages, no indicators, just the pit. Okay. After that, I actually went back to work for my father, and with a focus on crude oil spreads. Um, and I did that for some time until the floor closed and my family moved. And then I actually spent some time in the entertainment and fashion industry, just running all over the place. And due to the cost barrier for entry for trading back then, accounts, computers, connections, there was like a lost time where I still was involved in looking at charts and everything, but I was not actively trading. And so in 2020, I began trading again via options, and I had to learn how to trade all over again. Okay, completely from scratch. I currently specialize in long vol, SPX, and SPY trading, and I believe in being a master of one market. I've blown out accounts. I've made lots of money. I've lost it. I made it back, lost it again. And so goes on the trading journey that many of us go on until one day it finally clicks and you never look back. Okay. So, what's the theme song here? If you love trading, do not give up. Right. All right. On to the first most important chart in trading, the bell curve distribution. What does this chart represent? This chart represents the normal distribution, which is where 68% can round to 70 of the distribution takes place. Okay. So that is right here. The center is the mean. You have 1, 2, and 3 standard deviations of that normal distribution. 1, 2, and 3 standard deviations are more rare occurrences, with 2 being the main focal point for many trading systems and indicators such as Z-score. Z-score, also known as standard score, is a statistical measurement that describes the number of standard deviations a data point is from the mean of a distribution. Okay. So when we reference mean reversion, what that means, what that refers to is reversion from the 1, 2, 3, or more standard deviation back to the mean. Okay. It's important to understand that. Okay. Now, what are the examples of bell curves used in technical analysis? All right. So we have market and volume profile, time price opportunities, TPOs. The value area representing 68% of where volume or time takes place. The point of control, or VPOC, volume weighted point of control, representing the mean. Excuse me. Linear regression paths, a tool on all charting software that creates a bell curve distribution in the form of a channel on your price chart. Options market expected move. Based on implied volatility, the market will stay or close within the expected move 68% of the times. So, what are mean reversion trading strategies? Selling puts at the expected move low and buying calls, right? Selling calls at the expected move high and buying puts, placing a trade outside of the value area for a reversion to the point of control, placing a trade at the 1 or 2 standard deviation linear regression channel for a playback to the mean. These are all mathematically sound strategies, meaning they are backed by a statistical edge that is mean reversion. Okay. So this is not hocus pocus lines on a chart. This is mathematically sound stuff, and you really want to focus on stuff that's mathematically sound. Variance risk premium, also known as volatility risk premium, refers to the difference between option implied variance and realized variance of an underlying asset's returns. We will refer to this relationship as implied vol versus realized vol. Okay. So VRP, volatility risk premium, in simple terms, we could refer to that as VRP as the premium that the option makers charge to do business. They will sell you this option. They will provide you with liquidity. However, to do so, they will require a cushion, right? Everybody needs to make a dollar. So if SPX is realizing a 5 vol, market makers are still going to price that SPX IV at 18 or 20. And if the SPX realizes a 5 or even a 10, you still have that vol premium that could be harvested through delta neutral strategies. Okay. Not to be confused with historical vol, which we will get into later. Okay. So we are given implied vol by the market makers, and we judge the price of that vol against historical vol on a skew chart. And then we get paid on the realized vol for the day when that market closes. Right. So I'll say that one more time. We are given the implied vol by the market makers, right, by the option prices. We judge the price of that vol against historical vol via a skew chart, and then we get paid on the realized vol for the day when the market closes, right? Because we harvest that extra. Okay. Dodd-Frank, Wall Street Reform Act of 2010 introduced the Volcker Rule. Okay. What is the Volcker Rule? In response to the great financial crisis, we have Dodd-Frank federal law enacted July 21st, 2010. This rule restricts banks from engaging in proprietary trading strategies, meaning banks cannot trade to profit from short-term price movements like selling short-term duration options. They now have to limit how much risk they can inventory, how much risk they can hold, which restricts their ability to perform market making strategies. Okay. And this is so important to understand because this is the environment that we live in, right? So let's break this down a little bit further. So Dodd-Frank and the Volcker Rule reduced bank market making capacity, especially in volatile or liquid conditions. Banks could no longer hold large inventories or take short-term directional positions like vol harvesting, which reduced liquidity provision during stress. This created an opening for non-bank systemic funds, risk parity, vol control, CTAs to step in using rule-based models that buy in calm markets and sell when volatility spikes, effectively acting as a counterparty to the shrinking dealer function. Okay. These funds typically sell short-dated volatility indirectly via options or futures on the VIX, SPX, and equities, but they are not restricted by the Volcker Rule because they are not banks. Their strategies are often structured as long-term investments with dynamic risk targeting, not proprietary trading. So this rise that we see right here in systematic vol selling funds, right? Which is directly tied to prolonged low vol environments 2010 is not because the banks could sell vol, but because the regulation pulled banks out of liquidity provision, allowing systematic strategies to grow and amplify those volatility feedback loops. Okay. So what happens next? Exchanges provide, right? They introduce more products. Shorter duration options are introduced 0 DTE November 22nd, 2002. Okay. Introduced for vol selling strats. In the interest of saving time, I want you guys to go ahead and write this down. This is a really interesting study. Okay. Because I'm going to make a bold statement right now, which may shock, surprise, or you may know. 0 DTE index options, the quote unquote casino, right? The retail casino. Surprise, surprise. Options are sold and not bought. Okay. So people are selling these options, they're not buying them. All right. And I want you guys to reference the 2023 study from the Ambrose Group titled Dispelling False Narratives About Zero DTE Options. Okay. And you know what? Here you go. There's your link right there in the group. Okay, they go into great detail in terms of order flow, the times a day these trades are taking place. And it's important that we understand and are fully aware of this dynamic. This is so important to fully understand because this is the market that we trade in, and this is the dynamic that moves the market. And knowing when, how, and why larger traders will participate is a huge edge for the smaller and more nimble retail trader that is us, right? So spot gamma provides us with the positioning of these market maker funds, which is another layer of our edge that we take advantage of, right? Okay, next slide. Put call parity. What is put call parity? Put call parity is a fundamental principle in option pricing that establishes a relationship between the prices of European calls and put options with the same strike price and expiration date. Okay? Meaning, in a nutshell, calls and puts are the same. There is no difference between a call and a put with the same moneyness. Okay. So SPX European options cannot be exercised early. They are cash settled at the close. So besides the obvious directional difference, they are identical. While the Greeks are different for the call and the put at the same strike, when we look at moneyness, the Greeks are the same for the call and the put. And so we should see premiums that are equal in terms of moneyness. Okay. It's important that we remember this. Okay. We should see premiums that are equal in terms of moneyness for the call and the put. All right. So we'll discuss the difference between premium skew and implied vol skew in the coming slides. But I just want to pause for a quick moment, right, and drive this home. So in this picture right here is the gamma profile. I know it's a little bit small. Um, Let's see if you guys could take a peek at it there. I just posted it in the chat, right? So this is the gamma profile for Monday's expiration. It will be 0 DTE, December 22nd, SPX calls and puts. And you see they are the same, meaning that your call will trade just like your put. The gamma is highest for at the money options, okay? So when we look at an option chain, and we examine the premiums, not the implied vols. The prices for the call and the put with the same moneyness should match or be very close. The first, second, and third calls that are in the money should have nearly the same premium as the first, second, and third puts that are in the money when the market is stationary. Why is this so important? You guys may be like, dude, this is fundamentals 101. Okay. Because if we notice that calls are more expensive than puts, or puts are more expensive than calls with the same moneyness, that alerts us that the market maker is pricing in substantial risk in either direction. And this gives us a tradable edge. Okay. So let's start putting this all together. We now understand that there is a premium to options provided by market makers for their protection. That premium could be extracted from short duration options, and post Dodd-Frank, large traders are forced or incentivized to focus on extracting that premium, right? They cannot trade directionally. These banks, these images, excuse me, these images are implied vol skew charts and are essentially showing the same thing in two different formats. All right, I'll go ahead and give you guys these again in the chat because I got a feeling this is a little small here. Okay. So on the left, the spot gamma provided window, we can see that the 31-day Jan 20th expiration SPX implied vol is cheap when compared to historical vol, right? This is the historical vol cone, and we see the teal line, right? And it's under that historical vol level. Okay. So right now, historically, vol is cheap. To the right, we see a classic implied vol versus historical vol chart that gives us this same reading, but on a 1 year look back. Okay. And this is also this would be a fixed strike skew because this is relating directly to the 31-day option. And this is SPX index implied vol versus historical vol. So similar, but a little bit different. Okay. This is provided by Interactive Brokers, by the way. And I just want to take a really quick second to pause and show you guys something really cool. So look how this corresponds, right? We see right here that IV is under HV, right? So IV is under historical volatility, right? Under that orange line. Look what that coincides with. So vol is cheap, and then what happens? We get the cross and vol expands, and what happens? Look, wow, look at that, right? Then what do we have here? We have a time period where IV is over historical volatility, right? Meaning that there's a nice fat premium in the market. And what do we get? Look at this trend. Look at that. Wow. And what's going on right now? We could see right here. Look at the teal line. Look at the historical line. So we're in one of these scenarios where IV is under historical volatility again. And what are we getting? Right? Choppy markets, downside price action. This is extremely important to understand and be aware of. Okay. Understanding the systematic vol funds will harvest this risk premium from the market. We can clearly see that it becomes more or less advantageous to do so at different times. But these guys are systematic. Okay. So they sell rain, sleet, snow, or shine. That's what they do. All right. These charts alert us to whether we want to be buying options or selling options, but it also shows us when there is a risk for vol expansion. So when IV is historically low, this can precede higher volatility at the snapping point, right? We need to locate that snapping point. Okay. Next slide. The VVIX and the VIX. So the VIX is derived from SPX option implied vol. We then have the VVIX, which is derived from VIX option implied vol. Okay. So this is according to the SIBO white paper and methodology documents. The VIX is calculated using SP 500 SPX options with more than 23 and less than 37 days to expiration, which allows us for a precise interpolation to a 30-day constant maturity. This approach ensures the index reflects a forward-looking 30-day volatility expectation by blending near-term and next-term options, then interpolating between them. Okay. So this is the difference between fixed strike SPX option vols for a specific line or tenor, which will be different for the options inside that expiration, and that provides us with a skew. Okay. So again, for a specific line or tenor, the options inside that expiration will have different implied vols, and that provides us with a skew for that line or tenor, right? As well as the implied vol for all SPX options, which gives us term structure. Okay. So the implied vol plot for all SPX option expirations gives us term structure. All right. And then we now have the VIX, which is 30-day forward volatility for the SPX. And we also have the SIBO VVIX, which uses the same methodology for SPX's VIX on VIX options to give us 30-day forward vol for the VIX. Okay. So to go over that one more time, it's important to understand variance risk premium and also understand that dynamic exists in the VIX as well. Okay. So I hope a light bulb is going off here. Why? Because the VIX has options. The VIX has implied vol for those options. And so they are sold with a premium, just like SPX options. Okay. So that skew is different than term structure, but they are all closely related, and we could gain an edge by understanding their relationships, right? So we can find an edge in examining and understanding the relationship between VIX VRP ratios and SPX VRP ratios. What does that mean? If you wake up one morning and there's a huge premium in the market, then asymmetrically, the trade may be to harvest that, right? May not be to buy vol that morning. It may be to watch out because these guys may want to harvest that. Okay. So we're going to get into that a little bit more detailed. So pre-market prep at 9 a.m. Eastern, I record the expected move and implied vol. Okay. We'll go over how to do that in Thinkorswim. I do this for the SPX complex as well as well as the VIX as well. All right. So I'm doing this for the ES. I'm doing this for the SPY. I'm doing this for XSP and I'm doing this for SPX. And I do it for the VIX as well. And I go out 3 expirations for the VIX. So I want to see the nearest and the next two. And every day I record these implied vols and expected moves. And so after a while, what happens is you start soaking this stuff up. And you could just tell when you wake up in the morning, you could just see right off the bat, all right, I've been seeing this for a couple of days. Looks rich, right? And so is the VRP rich? And if so, is it rich enough to slow the market or cause chop for the first 1 to 2 hours, right? Is the premium skew asymmetric? Meaning, is there a difference between the call or the put at the money, right? Or at the first moneyness? This dynamic can be the difference between a 9:30 breakout or a 9:30 to 11 a.m. chop. Okay. So rich IV being harvested in the VIX and SPX can lead to bullish price action, right? Asymmetric premium skew can lead to reversals. Both can lead to choppy markets at the open when the premiums even or the vols contract. We will then see price breakout to the upside. However, if IV was cheap and the expected move was understated and traders buy that cheap vol, this can create downward price action and high volatility. So understanding this dynamic is the best pre-market edge that you can have. And when you layer this understanding with trace open interest and gamma profile, you can get an extremely potent signal with positions giving us directional clues that result in a huge edge for retail traders. Okay. SPX high of day, low of day. Let's look at a chart of high of day and low of day by time in 10-minute buckets. Okay. So what do we see here? We can see that there are certain times a day when the market makes lows and highs for the day. These times also correspond with reversals, meaning market tops and bottoms. We can use this study to overlay scenarios and probabilities as the day progresses. All right. So I'll share this with you guys here. Many of you may already have this because we've shared it in this chat many times. Shout out to Matt, ST student, who helped me with the coding for this. Okay. And next, we're going to look at NVIDIA. This is the same study for NVIDIA. Okay. High and low of day, which also corresponds with tops, bottoms, and reversals. And we could see that NVIDIA makes its decision in the morning and rarely reverses in the afternoon, but has a higher chance for reversal before 10:30. Okay. This is crucial to understand for our next tradable edge, which is using tech as an indicator. I've spoke about this in depth in my previous video, but being that this is like somewhat of a masterclass, I'm going to touch on it briefly since we'll be referencing it in some of the trade examples in coming slides. Okay. So if some of you have seen the video that I did, I think it was like the original video, and I'll share a link for that at the end in case anybody missed it, where I go into this in great detail, but I'm going to touch on it again today. Okay. And so the next slide is about correlation and big tech. Okay. So as we can see here, the heaviest weighted stocks in the SPX and the QQQ are the same. This creates a correlation between the SPX and the QQQ. SPX, XSP, and SPY, okay, and the QQQ. If the QQQ is weak or strong, or has a breakout or reverses, the SPX is due to follow. This gives us a huge edge, and we could use this to our advantage by watching these top 9 tech stocks and front running their price actions effect on the SPX index. Layer this with VRP and spot gamma positioning, and you get a very clear picture of what's happening and what can happen if things reverse. Okay. So you could go ahead and Google this. I'll go ahead and share this with you also. They're identical, so I don't need to give you both of them. All right. Now let's talk about some potent positions on Trace. Okay. I'm going to touch on this just briefly here, and I have a guideline that I'll share with you guys for trend days that dives into this like a little bit deeper, but I want to point out some really potent positions here on this day specifically. And then we're going to go into this trading day in detail. And I'll share this with you again here in the chat. So this is the 9:30 open update, right? And you'll see 12:15, we have the presence of the 0 DTE trader short straddle, right? So right here and right here, we see these are trader shorts. Traders have sold these straddles, okay? That means that they're planning for the market to stay within the expected move, okay? So they're expecting vols to come in. This is pretty much bullish or sideways price action positioning, right? And then what do we have? At the next update, look what we get here. Look at this clue. So at the next update, we see they close them. So the trader said, wait a second, I'm closing this position because now I think that vol is going to expand. Okay. And why this is so important, because short straddles, especially, are in size, are typically not really a retail trader strategy. This is a delta neutral strategy. It requires a large account. The risk is unlimited on either side, right? Because you're short 2 options. And so you're going to need a large account. You're going to need full options permissions, and you're going to need a huge margin, because SPX margin for naked short options is gigantic. Okay. So if you're going to put 1,000 of these on or 500 of these on, even one, you need to have a really, really big account. Okay. And sometimes brokers may not even allow you to do that. All right. So this is really important to pay attention. This way we could stay ahead of the curve by paying attention to the nuances that are the positions and position changes in Trace, right? So even though we see the ones that stand out, which are like, yeah, long puts, right? We see a call spread up here. We see a call spread at the money. So those are all kind of clues in a way, right? Because those are pretty bearish, right? We see traders are short these calls, and we see they're long these puts, but we do kind of see some short puts in here also. But the closing of those short vol strategies, right, really alerts us like, hey, something changed here, right? And you could see in the price action that things got pretty wicked. It gets a little confusing here. And so I'm going to show you how I navigated this and actually had a really great day. And then you guys can apply the same tools and have similar results, hopefully, right? Next slide. Reacting, not predicting. So many people ask me all the time, hey, what do you think for tomorrow? What do you think for this? What do you think for that? I come into every trading day like I have no clue what's going to happen. All I know is if the VRP is fat, all I know is what these guys are positioned for. All I know is what tech is doing, and I am ready to react. Okay. I may go long, I may go short. I'm not married to anything, and I can change my mind in a second. It is very easy to get married to a prediction, okay, and try to think too much and plan out this great trade. And that could really get you in trouble, right? Because a lot of us are smart and we do great analysis, and the market can do weird things. So, in the end of the day, okay, we put pieces of the puzzle together, understanding what larger traders are likely to do today based on variance risk premium, and we get ready to react. Again, don't waste time marrying a prediction Instead, understand what the current conditions are and be prepared for a likely scenario to play out based on real inference derived from mathematical components like standard deviation and distributions, or implied volatility to historical or realized volatility, market maker slash trader open interest and gamma profiles. Okay. So these are all the things that we want to be paying attention to. These are the core components to my trading system, and it works. All right. So let's look at some real examples, and I'll show you some of the indicators and tools that I've developed to help me react to these opportunities in the SPX and the SPY. All right. The fun part. Let's look at some charts. Cool. All right. So for those of you that have Thinkorswim, if you have TradingView, TradingView, to my understanding, does not have an option chain. That's going to really hinder a lot of your analysis because the option market is a source of information for traders. And so you really want to be able to monitor that. And I think while I don't trade, you actually see there's not even a dime in here. I don't trade on Thinkorswim. I execute on interactive brokers and I literally just execute on that. I don't really think their charting is all too great. They do have some cool volatility stuff, the Vol Lab and some of their open interest positioning and 3D vol surfaces are could be handy. And they got a cool API, so you can make some tools. But I really think that Thinkorswim is just such a great charting platform, and just the way they did everything, it's really one of the best. And so I chart on Thinkorswim. Okay. And so the first page, and I'm going to share this with you guys. Um, okay, this is going to give you, this is a line chart. All right, so I set this up here using, we go to studies, we click studies, and we're going to use the comparison study. Okay. And we're going to put our big 9 stocks and we're going to color them with Roy G. Biv. Okay. This is an easy way to just put things in order, right? Red, orange, yellow, blue, indigo, violet, right? So we're going to just use that. And you could remember because you could go in forward or reverse. You can go violet, indigo, blue, right? And you can go backwards or you can go forwards, right? Red, orange, yellow. And so however you line that up, you'll eventually get used to it. All right. I put another comparison down here, and this is the New York, excuse me, the New York Stock Exchange NYSE tick. Okay. And so I put a 0 line here. I do one at 250. I extend it left, do another one at 500. And I prefer to have this on a line on close chart. All right. Because I really feel that it gives you a more clear picture. The candle charts is like, it can get a little fuzzy and hard to read. So I like a line chart for the tick. All right. Um, and then I put the VIX right here in another comparison. And then I have a study that was shared to me by a gentleman that's in this chat, one of my mentors, Charles. Thank you, Charles. This is a shadow trader. This is a shadow trader weighted AD. I could share it with you guys also. And so this is really cool because this gives us advanced decline, but it's weighted. So at the 9:30 open, this weights. This is tech right here, right? We got the financials, health. And so this goes ahead and just gives us a weighted view of the index, right? Because this is the inside of the S&P complex, right? So we're watching the inner workings of what's going on over here in the SPY. So this really can give us like a heads up, right? Because if we're watching this, and after a while, like I know this is AVGO, I know red is Tesla, I know this is Nvidia, I know this is Amazon, right? So I just remember all these after time, and it really lets you see like what is happening in real time, right? If we go to 12:15, look at this, right? And we have this one guy, Tesla, like the last man standing. When that guy rolled over right there, okay, look at this. What does this correspond with? The 940 trace update, right? So that trader closed those straddles And he probably did it because he realized that tech is dumping. Okay. And so you could see how that works right there. And so over here, I use what's called linear regression channels. Okay. Um, we'll go to this chart for these. All right. And so this gives us that bell curve distribution in the form of a channel on our chart, right? So this is mathematically sound. Let me go ahead and close the spot gamma level for a second just so we could really look at what this is, right? So here's your mean right here, this yellow line. Here's your one standard deviation. Here's your two standard deviation, right? And so if you look at that relationship, right, this is the same thing, same concept as the expected move. This is the same concept as a value area. This is giving us the essential volume weighted point of control, which is this yellow line, right? It's going to be the same thing. And then you're going to see, actually not volume weighted, but same thing. And so, and here's your two standard deviation line, and you can see how the market reacts in between these levels, right? So when you go and you draw this on a chart, all you're going to do is because these are actually a little bit weird, and I think that if you're transitioning from like a typical just like trend channel to this, it gets a little confusing because this is going to do the math for you. You don't get to make these line up at the top or anything like that. That's not what this is all about. You're going to click in this candle and you're just going to drag it through to that candle, and this thing does the math for you, and it makes this distribution path. Okay. And that's mathematically sound. That is backed up. Um, that is supported by standard deviations. So this is something that we can trust here. Okay. And then I have my VIX chart. Okay. And I keep this on a 5 minute chart. Okay. And what I have added here is a proprietary study. This is called a reverse engineered RSI. And I'm going to show this to you on this chart on the VIX. Okay. And I'll pass you guys this study. This is something I made myself. Thinkorswim actually offers a study right here called reverse engineered RSI. Okay. And what that does is it plots RSI 50, okay, on your chart here. So this red line is RSI 50. This top band is RSI 90, and this bottom band is RSI 30. Okay. And we could see how great this works. Look at this right here. I also add one more thing to this. And I know this may ruffle some feathers because a lot of people are like, hey, the VIX is a mathematical computation and you can't chart it. And I would push back on that and I would say, you know what, but there is a supply and demand aspect to the VIX because there are options traded on the VIX. And so I'll push back there and I'll say, hey, look, it's working and it works and I use it and I trade it, right? Um, and so there's one more thing I have here on here that I keep, and that is a 17 EMA, and that's plotted right here. Okay. And that's plotted right here. So why do I use the 17 EMA? I'm going to be honest with you. It just works. I mean, look how it respects it. So this just takes some time to sit there and plug in moving averages, and you just see like, okay, this it respects it. Why? It doesn't matter. It absolutely does not matter. Okay. And these dotted lines that you're seeing right here are a study that I created that basically just plots the initial balance for me, which is the 9:30 to 10:30 first hour of trade, right? So here's the top of initial balance. This is the midpoint of initial balance, and this is the low of initial balance. Okay. And so what we could see here, remember that the topic of this is timing the market, right? So too many times I see traders in the chat and they're like, "Oh, I lost money." And I'm like, "Well, what happened, right? What went wrong?" So we could use this to time the market properly, right? So when we see here that the VIX is rejecting off RSI 50, okay, this is going to be a long signal for the SPX. Okay. And this works so good that I am confident that I can trade this without even seeing an SPX chart. Why? Because the VIX is inversely correlated to the SPX. Okay. And the VVIX, again, is is VIX implied volatility. All right. So we're going to use the VVIX as an indicator for the VIX, which alerts us to the potential for a change in price in the VIX. All right. If we have a situation where, um, let's go ahead and use my favorite day. Um, Actually, let's just get right to it, right? First, I'm going to just show you really quick how that helped, how this chart helped me on this day, on the 15th, really quick, and then we'll get into exactly how to use that for timing, just to keep everything flowing in order here, right? So this is the 15th that we shared that video, right? And so here's something funky that happened this day, right? This is a 5-minute chart. This is where I like to reside. And so I also keep the 30-minute over here. So if I need to go back and see what's going on like a bigger time frame. And so, because you could get wrapped up in these smaller time frames. So it's really important to have the linear regression path for the week so that you know the actual direction that it's trading, right? And then you could overlay that and zoom down. It's a little bit, lines going on over here, but and it may seem weird to you guys, but again, it's my chart, so I understand it and I know where we are on the big scheme of things because right here we are, and I keep these things color coded again. So yellow is going to be the mean, blue is 1 standard deviation, and red is 2. And you could color code yours how you like. I use purple for my expected moves every day. So every time I see a purple line, I know that's the TOS high from 9 a.m., right? And I also plot the spot gamma as well. So I plot them both. Okay. And so on this day in particular, right, when we go back to the trace image that you guys have over there, the first one, and we see these guys are short these straddles, right? And so we get this dump on the open, and then we see these guys are trying to buy this. So we already knew that they closed their short straddle positions. And if we look over here on our handy dandy Mag 9 chart, we'll see that the weighted AD is dumping off the open. We see that the VIX is absolutely ripping. We see that the tick is dumping, right? And so even though you get these two little fake outs where you might want to buy it, because we're overlaying our trace positioning with our Mag 9 indicator, right? And we're paying attention to the VIX and the internals of the S&P, we're actually going to go ahead and add to our short here, right? So I actually added on my short here. And we had an odd low. It was 10:30. So I got to be honest, that actually kind of caught me by surprise because it is not really, if you look at the high day, low a day chart, it's not like one of the biggest lows of the day. But that's how you could use that high day, low a day chart to just get a gauge. It's like, hey, am I going to cover for the day right now, or is this a type of low that I could trust? Typically I would say don't trust a 10:30 low. That's really my rule, but this day was a little bit funky, right? And so this chart really kept us out of trouble. So having this up in the morning and realizing like, hey, even if you see this and these guys are trying to buy this right here, okay, and you're like, I see Tesla as the last man standing. And this thing rolling over is going to cause this cascade because everything is going to join. Why? Because Tesla is one of the heavier weighted stocks in the index. And so that stock can hold up the market. Nvidia can hold up the market. People always say, like, hey, we have really bad breadth in the market. And breadth means that the broader sectors. So if we go to Market Watch and look at this on a like table type of view here, heat map, right? These are the other sectors of the market. And so because tech is so heavily weighted, all of this can be red. But if tech is green, it doesn't matter. We're going to rally. Okay. And that's what everybody says. This is the worst breath ever. But you know what? That's a tradable edge because now we know that the whole market is hinging on this tech rally. And so if that gives up, And guess what happens? Down we go, right? So this is a super, super effective indicator using the tech sector as an indicator. Okay. And you guys can go ahead and make that. I'll share the grid at the end. I'll put it in the put it in the Discord. And you guys could all share that. Okay. And next, we're going to talk about premium skew, and we're going to deep dive 1218. Okay. 1218 was a really, really, really weird and crazy day. And this is where I had that insane gain. And quite frankly, the options blew out 900% that I was long. Okay. I went ahead and, took my profit a little bit early, which is fine with me. I still did about 500% open to close on the position. But they blew out to be about 900%. Okay. They went from $6 to $50. All right. So I had an awesome, awesome day that day. And as much as I love, respect, and use spot gamma, okay, you would have missed this and could have potentially been caught long if you're not adept to the nuances in trace. Okay. So if you were just like kind of like a new guy blindly using trace and looking at this day, um, let's check out what it really looked like before it dumped, right? You could have really got caught, right? So here's what does this look like to you, right? This looks like a bullish consolidation to me, right? This looks like if you miss buying this dip in the morning, right? And you're over here, you say to yourself, well, here's my chance to get long. And if we come over here and we look at trace, which I'll bring to the window, okay, and we go to 1218 and we come over here to the 1130 view, right? What do we have going on? So we're at negative 1 billion up here. So you're like, hey, wait a second. Like what's going on? Right? This is weird. We just had this huge bullish move and we're sitting over here, but we're negative 1.1 billion. So that's alarming. But at the 1130 update, we see that start to reverse, right? And you actually see, look at the bullish positioning. We got short straddles. We have short puts above the market, right? That's super bullish. We have short puts, right? Trader short puts. So this is super bullish. And then if you notice what we have here, we have a wide butterfly. So we have two short strikes here and we have the two long strikes. So this is a trader butterfly and they're expecting consolidation up here at 6,800. So based on trace, I mean, aside from this alarming hero, right? This could be kind of confusing for somebody that is not really adept with trace. And so you may expect us to kind of like consolidate and get sucked up into these 99 percentile strikes, but this is also resistance. Okay. So you got to take that into consideration. And what's beneath us? Nothing. Many times we don't see this materialize, right? So a lot of times we see this and we just kind of get sucked up and caught up in this positive gamma. But look at the risk down low, right? On the gamma chart, right? Let's go back to open interest. And then what happens at the 1140 update? Whoa, look at that. So we get a million, a billion positive delta flow in under 10 minutes, which is a bullish rate of change. So now you're saying to yourself, like, okay, I could get long this thing, right? Because we're going to expect this to trade around this guy's fly, right? We got all these short puts in the market, and we just saw Hero give us a bullish confirmation, right? So this was a little bit confusing here. Um, And if you really weren't smart enough to, at a minimum, hedge this long right here, you really could have got caught bad. And so just to touch on hedging, if you are long in this situation, right, and you have this positive gamma resistance up here, well, that means that your upside is kind of limited. You kind of got a roof here. Okay, but these positions can change. So if you want to stay long, well, you got to throw some hedges on up here, right? So you want to hedge your deltas in a situation like this, especially when we see Hero um, giving it up like this, right? Now, let's go to some of the Discord chatter from December 18th. Okay. So actually, these go in reverse right here. So starting at the bottom. So I said at 9:45 when I was looking, I trade SPY in the morning. Because the SPX options are just super expensive in the morning, like 2 grand at the money. So if I want to grab a couple of those, that's a lot. So I like to trade SPY in the morning, and then I transition into SPX after theta kicks in and the zero DTEs get a little bit cheaper and I get more bang for my buck, right? So that's how I do that. And so I said this morning, I was like, really wide spreads are suspect, and they're pricing this like it's going to dump. Okay. The SPY spreads are oddly very wide, and the puts are priced 2 times the calls. So I said, I'm flat right now with my finger on the trigger for a short. Okay. And what happened? The market rallied. But here we are at the open. Okay. And I'm going to share this picture with you guys also so that you could just go ahead and take a peek at what I'm talking about. And this is premium skew. All right. So we're going to look at the December 19th expiration. And we're going to go ahead and we're going to look at how wide the spreads are, right? So they're about like maybe 10 to 12 cents wide, right? But also look at the on the puts, they're wide, right? And look at the 679, right? So the first put in the money is $4 and the call is $2. What? What is that? Okay, and then if we see the premium skew in the zero DTE is not so pronounced, but in the one DTE, they're pricing in substantial risk. And so this is alerting me that something is wrong. Okay. And so when I see this premium skew, a lot of times what happens here is and pretty much every time what happens is the market will stay put um, the market will stay put until this evens out. Okay. Because even if you're bearish, especially when you see this in the zero DTE expiration, okay, if the market opens and we see this spike right here and we're all super bearish, we want to buy puts right now. Okay. But we come over to our option chain and the at the money put is $4 and the at the money call is 2. Are you really going to pay $4 for an at the money SPY put? Right? Because that can happen in the zero DTE also. And so if you come to the zero DTE and the put is twice the price as the call, are you really going to pay that? I'm not going to pay that. I'm going to say to myself, well, wait a second. This is a little bit crazy right now. And so a lot of other traders are going to pause also, and this becomes a self-fulfilling prophecy where the asymmetric trade becomes to sell that rich put premium and buy the cheaper skew, which is the calls, right? Because that's how you play skew premium. And excuse me, that's how you play vol skew, and that's also how you play premium skew, right? You're going to buy the cheap and you're going to sell the rich, right? That's how that works. And guess what we get? Boom, we get a big move higher, right? So that works, okay? But as somebody who's like pretty adept to this and arguably one of the few people that really trade this dynamic, I really only know maybe one other trader in the whole space that actually really trades option premium the way I do. um, and so it's a rarity that people are taking notice to this. And I said, normally that's a play for a rip, and I'm not sure why I didn't buy that. To be honest, I've mentioned many times put call premium skew, and I admit, I guess I made a mistake here, right? And I noted that the Trace Zero DTE 6800 uh short put long call, right, which is bullish, right? The 6,700. This was trace positions on this day. So if everybody's on trace, we can go ahead and go to our open interest, right? And so 6,800, right? Short put, long call, 6,700, short put, long call. So that's like a reverse, that's a reverse risk reversal. That's playing for a long, right? That's a synthetic long is what that is. So that's bullish positioning. So really, again, and we have this rate of change right here. This is looking pretty bullish, but spreads are 20 cents wide. And that's pricing in a lot of downside risk on the on the option premium, on the premium skew. And I'm seeing some big prints hit the put tape. Um, it also may be a sale, right? Because I don't have the matching tools that Spot Gamma has. And I'm just really not sure, but it's alarming. And so I missed that long right there. And I actually was a little bit frustrated that I missed that because, like I said, when that premium skew is asymmetric like that, you want to sell the put and you want to buy the call. It only makes sense. Even if they even out, okay, then you're still going to make money buying the call and selling the put while they even out. It could be a shorter trade, it could be a longer trade, but that is asymmetric and you want to go ahead and play that, okay? And then what I do is I point out here that I got into some puts. All right. And it's becoming like increasingly difficult to make call outs in the Discord and then like manage my own risk. So I'm doing the best to give you guys like timely call outs. I try to not, a lot of times, trading is confusing, right? I could be looking at calls and then look at puts and then decide, all right, I'm going into calls. So if I got to change my mind three times in front of you guys, I don't know who clicked what. So I try to just kind of, if I'm not so sure, keep it to myself. And then for the times where I see like, hey, this is something substantial that people are missing, I'll go ahead and then throw that in there so you guys could catch it, right? And so what I post here is a beautiful failure and rejoining of the linear regression path. And so let's zoom out, right, to our 30-minute chart and let's see what we have, right? We have this linear regression, right, for a whole entire week here. Um, and we have us up here. This is where we are, and we're failing at this two standard deviation level. So even though we have bullish trace, and quite frankly, when this breaks out at two standard deviations, you should be expecting this, right? You should be expecting a huge break in trend. You should be expecting bullish price action. And so, quite frankly, I was really expecting due to the premium skew and everything. I'm like, man, this thing is finally going to rip. Okay. Your 7,000 play is back in action, right, guys? And so I come and I look at this and I'm saying to myself, like, I'm not long. So I'm buying 6,800 puts right here. Okay. And I don't have a clue where this is going to lead to. I don't know. I'm just reacting. I'm just reacting to circumstances. I'm reacting to the fact that we're at two standard deviations, which is a mathematically sound level, right? I'm reacting to the fact that the market maker was pricing in substantial risk that this is not normal. Okay. This is not normal for the spreads to be wide like this. The market makers are saying, like, hey, like this could dump fast. Okay, that's what that's saying. They're pricing in downside risk. And the spreads are really wide, right? So I'm saying to myself, like, wait, something is going on here. And so um, I said I was expecting a huge trend day. And so on this chart right here, I have 12, 19 spot gamma levels. But you'll see that the SPY call wall was also right there at 6,800 or 6,810. So again, selling options at the call wall, right? Buying puts at the call wall. So again, somebody who wasn't like a spot gamma more adept, more educated spot gamma user, you could have really got whacked there. But some of the guys that are more seasoned understand that, hey, we're at the call wall, right? So upside risk is upside potential is getting limited. We want to sell calls at the call wall. We want to buy puts and hedge. And then boom, what happens? We get this Oracle news that came out, right? And so this thing just absolutely gets hammered. Okay, we'll go here. Let's check it out over here, right? And so here we are, right? And this thing just gets absolutely hammered. Okay. And these 6,800 puts that I bought, they go from $6 and they blow out to $50. All right. So this is just, I mean, this is the type of stuff that makes your month. You know what I mean? This could make your year. If you grab 10 of those puppies, I mean that's an insane day, right? So you're making like 40 something thousand dollars just doing like a really easy trade. And that right there is what trading is all about. We're not planning or predicting, I'm not thinking anything crazy. I'm not overthinking anything. I'm just weighing out the options, right? And I'm looking at where we are and I'm ready to react to the circumstances, right? And so I zoomed out so you could see that I keep my linear regression path that I showed you from the 30-minute chart. And so I knew that we were outside of this thing and I knew that we were hitting this wall, right? And so zoom out a little bit here because I keep a couple of these things on. And so you see this dotted line, that's from another linear regression path and it's getting whacked. And so this is how I like to do it on my chart. Um, and so everybody could do it on their own when I draw a linear regression path, right? If we go to the properties, I add curve and I do the halves. So I put half a standard deviation, I put 1.5 standard deviation, I make them white or gray. And then I also go ahead and I put these dotted lines in there. And so that just lets me know, like, hey, these are the halves because these get respected also. Okay, so they're in there. And then sometimes if I'm zooming in on like a smaller channel, I won't have them in and I'll just leave it like this and I'll just go ahead and come in here, right? And unclick those, right? And then there we are, right? So that's how we could use this methodology that I've shared with you, right? Layered with spot gamma, right? Layered with all the things that we've discussed to really gain an edge and a more robust system for managing risk, right? And then let's go over here back to this is one of my main trading charts. Like this is where I reside during the day. Okay. I keep that VIX chart, this puppy right here. I have four screens. So I have my left screen where I keep this. I have my center screen where I reside between this chart and my zero DTE straddle chart. We'll go to that next. I know a lot of you guys are interested in that. And so that's where I reside during the day. And I have spot gamma on the left chart with the VIX, right, in a small window so that I could see what Hero's doing. I keep that on the bottom left. And on the right, I have my execution window. So left, center, right now, I keep my execution window, which is Interactive Brokers. That's where I keep my option tables and my book trader, some of the Vol Lab studies that they offer on Interactive Brokers, which can lag a little bit. For them running live, I would say, maybe not the quickest, best updating, but they do help a lot. But look, back to our using tech as an indicator, right? Where are we at? Oh, this is Google rolling over at 11 o'clock. Okay. Nvidia's flat. And we're starting to see these things. Look at Tesla's falling 1150. Look at this, right? And so here's the tick. Look at the tick from 1040 just falling apart. And I have it overlaid with the VIX because look what's happening, right? Tick is falling apart while tech is climbing. This is a divergence. This is weakness into the rally. Look at this. Declining, declining, declining. VIX starts rallying, right? So here is our warning signal right here. And here was the most potent signal of the day. Okay. For me personally on this, as somebody that really, really trades and monitors closely the VVIX and the VIX relationship. Okay. This was super, super, super potent. And it alerted me to the fact that we had room to really, really dump. Okay. And I told everybody this can go right through the low of day. All right. So on my right window, I'll dive into these indicators in a moment with you guys. These are some proprietary stuff. developed by myself and Charles, who's in the chat also. Hey, Charles. Um, let's go ahead and mute these for a second just so I could show you clearly. All right, so here we are, and we're seeing that we have truncation in the VVIX, right? So see this little small little baby candle right here? Um, so it's at RSI 30, right? And we see how this respects this these RSI bands. I'm going to share this with you. And so I see this right here, and this is at 1140, and it pops. And I know that this thing wants to go to RSI 50. Okay, that's how this works. This is a buy for me. Okay. Now also, um, I'm looking at the VIX being flat into this rally. So this is not what I want to see. I want to see the VIX. Oh, I'm on the wrong day here. No, I'm not 18. Okay. Sorry about that. So I'm seeing the VIX is flat here, which is not what I want to see for a rally for a trend day. Okay. I want to see this VIX selling off. I want to see falls coming down, coming in, right? And that's going to give me bullish drift. And so I'm not seeing that, right? This is during this consolidation period that we were wondering, like, hey, what do we do here? Right? Let's go back. This is during this period right here. And so we're not seeing vols crush. We're seeing vol being sticky. And then what do we see during this time period, right? We see the VVIX, which alerts us to VIX implied vols. So this is pricing in risk in the VIX, right? And so we start to see this move, and I'm in puts. And I tell everybody, hey, I'm in puts up here at the top. All right. And so we see the VIX absolutely explode. And we get all the way to an overbought condition, and we see this come and expand also, right? And so typically, if we actually zoomed out of this and we looked at a daily chart, this is why I was saying like it's important to really just always record these levels in the morning, so you can understand that as of recently, right? So here's 2025. Like let's look at 25. So what's a cheap implied vol, something that you would want to buy and not sell in the VIX VRP, right? Let's really examine this. So look, here's 94. So we see this thing gets as low as like 80, right? But I would say like 94 to 84, 85. Like this is a zone that you want to be buying vol. You don't want to be selling vol in these compacted areas, right? So this is letting us know like, hey, like we're at a floor here. So when we talk about skew and we talk about implied vol skew, right? We should be able to visualize this in our minds, and we should be able to say to ourselves like, man, this is cheap, right? This is cheap. This is something that we want to be watching out for expansion. We want to be alerted to the fact that we can have expansion, right? And so that really gave us that edge that day. And again, when you're trading these things, right, the true way to do this stuff, you want to trade small, okay? And the market is going to give and it's going to take, okay? And if all you do is just stick to your guns, right? You put your size on and you don't go overthinking things, you don't try to go too big, the market will give you these wonderful returns from time to time. Okay. I had no idea that we were going to sell off like that day. Okay. I had no clue. All I know is that we're at the call wall. We got gamma resistance. Okay. And so I'm going ahead and I'm buying puts, and then Mother Market goes and gives me this beautiful gift, okay, which is like a 900% return that I was able to lock in 500 of that on that position. Okay, so awesome, awesome day for me. Definitely the biggest day that I had in December so far, right? That was absolutely an amazing day. Okay, let's go over and talk about the straddle now, right? And what the straddle tells us, the zero DTE straddle. All right. So we're gonna go, this is the 18th, okay? This is the second window where I reside. This is where I spend primarily most of my day. Okay, right here. Why? Because I have everything I need. I got the tick right here. I have the VIX right here, right, which is interpolated 30-day forward IV for the SPX. And then I have something really cool, which is the VIX 1 day, which uses one DTE and zero DTE options to give you a more sensitive vol reading for zero DTE traders, right? Um, and so I also keep my weighted AD over here, right? And I mean, really, there was just so many signals. I mean, even though we went from like negative 220, we got even on AD and we were cruising up here and stuff like that. We had the VVIX alarming us. We were at the call wall. So, getting caught long up here really was a mistake, right? You should have at a minimum been hedged just due to the call wall aspect. Just due to that change in hero, right? From just going negative when we were up there, even though there was the rate of change, you still got to say to yourself, like the upside is limited here, right? And so here's where I reside. And let's talk a little bit about the zero DTE straddle, right? Which is the expected move for the day. All right. So let's pull up. This is the 19th. I'll go ahead and I'll change this to the 18th. 8, 8. And where did we open? We opened at 67.70. So I'll change this to the at the money strike 70. 70. Boom. All right. So here is the zero DTE straddle, right? And what does this give us? This gives us the expected move, right? And so how can we find this? If you're on interactive brokers, what you're going to want to do is you're going to want to open up your option chain. You're going to open up the strategy builder. Okay. You're going to put in a simulate, well, not simulated order, but you're going to put in an order to sell the at the money straddle. And then that's going to populate a window that gives you a performance profile and the option to add that to a watch list. You will then add that straddle to the watch list, go over to your watch list, right click, and then you're going to go view chart. Okay. And then you can have this line on close chart. All right. And so if you want to change to a line on close chart on Thinkorswim, you're going to come over here, chart type line. You're going to color this all the same. Okay. And so that's how we're going to look at our zero DTE straddle. I keep my RSI 50 study reverse engineer on here. And I also add the VWAP, which is this green line. And I keep the two standard deviation in a very light thin gray. And I keep the RSI 90 and the 30 in a little bit of a thicker gray. Okay. Just so it stays out of my way, but I'm alert to where VWAP is, which is different than RSI 50, right? But you could see the respect, right? The VWAP, because traders play VWAP, right? Traders are not going to play RSI 50, okay? Just because you're at RSI 50, traders are not going to start buying, okay? This is a guideline, right? This is telling me like, hey, if I'm under this, right, then the zero DTE straddle is selling off. If it gets here, I'm alerted that we could potentially have some expansion, right? And what do we see? We're flat, and we do get some straddle expansion, right? So again, look at us selling off, right? We're at here at 30, and what happens? We get some expansion, right? And so this is all coincidental. Again, nobody's buying off the RSI reverse engineered line. It's a proprietary study. It's a very low-key study. And what it represents is the RSI indicator, right, on a chart underneath here, like I had up here before for you guys. And you'll see that when this is at 50, right, RSI is at 50. Okay, so this is like no man's land, right? Now we're selling off, so this is bullish, right? And now we're getting to a point where, hey, this could bounce. And we bounce, right? So this works really, really, really good. And I'm telling you right now, I know a lot of people have pushed back on technical analysis in the VIX. Again, I push back and I say that technical analysis in the VIX will work and it will continue to work better and better as supply and demand dynamics are increased through trading, right? Through option trading in the VIX, which is becoming more and more popular. Okay, so we have our zero DTE straddle. We're going to get that by going here for Thinkorswim. We're going to change our template and go to straddle. We're going to go down to at the money. So when the morning opens, we're going to find our strike price and say, let's just say this is 6,800 and we open at 6,800. We're going to right click right here. We're going to copy it, right? And then we're going to go ahead and add it to our chart right here by pasting it. Boom. And then I have my main studies that I always keep, which is the initial balance lines. That's another proprietary indicator. It just sets up on the chart for you. I will share it to those who want it. I have my NICE tick. And again, we went over the VIX in the 1 day and our AD line. All right. So what is the straddle telling us, right? The straddle is the expected move. So if we opened up this morning at 40, okay, which actually is a little rich recently for expected moves, right? We've been seeing a lot of like 35s, 38s for this week. And so they give us this 40 straddle, right? And so my little spider senses in the morning were telling me, like, hey, guess what? Let me share one more thing with you really quick. This is going to tie into journaling, but I do this every single morning. I call this my market monitor. All right. And so here is the 18th. And so we had this core CPI number that morning. So that was like super bullish that we had that, right? I do my initial balance. We'll go over that in a moment. I do value for market profile, right? Because I love my market profile charts. Um, and for those of you that don't have it, if you want a really good market profile charting platform that is cheap, relatively cheap, it's 150 bucks. It's called Sierra Chart. They link with AMP futures. They link with a ton of futures brokers, but they give you awesome futures margins. So I pay 40 bucks for a mini and I pay $400 for an ES future contract, right? And so this market profile chart is giving us, again, this distribution, bell curve distribution, right? And I have this set not to time, but to volume. Okay, so here's a key nuance because time price opportunities originally they aggregate the value area with time, not volume. So I go into my studies and I adjust that and I make this volume. So this pink is the point of control, but it's the volume weighted point of control. Okay. Pink volume weighted point of control. And so we see this value area, which represents 68 to 70% of where trading takes place, right? And then we have the edges. So typically you want to sell these edges, right, for mean reversion to the POC, and you want to buy these for mean reversion to the POC, right? And so we could look at this. There's all types of really, really cool. I could do a whole hour just on market profile. If you guys want me to, I don't know how many market profile traders are. It's something we could explore in the future. But so I just wanted to really point that out really fast because when I say value, it's important to understand that value is trending higher, right? So even though we have all this craziness going on in the market, right, from the 17th to the 19th, the end of this week, value is moving higher, right? So that's bullish values from here, right? And then guess what? It's higher to overlapping. So we're still within range of the 17th, but value is higher, right? And at the close, what do we have here? At the open, we opened within value and we saw range expansion. So we rejected this prior value. We said, oh, nope, that's not good for me. I think that this is worth more, right? And so we rallied and we had this is Friday's price action. And so we created this value area up here in this distribution, right? We get a pullback that literally just goes to the low of the value area and comes back up. And so you see where the volume point of control is, right? So down, you want to buy that at the extreme, right? At the edges of one standard deviation, and you get that mean reversion. Okay. It wasn't really like the most fruitful trade. And so that's maybe like a poor example of risk reward on these. But again, this could dump all the way down to here, right? And so you'd be looking to buy here to come back in, or you'd be looking to at least be short up here against the top of the value area. That's how you would want to play that, right? So let's come back over here. So again, so we have a expected move of 40, right? And so I record all this stuff and I say, look what I said this morning. Looking rich for SPX, looking cheap for the VIX, right? So this is my vol assessment, um, just blindly knowing this over time and saying to myself, and just saying to myself, like, because I record this every day, right? And if you see right here, I say to myself, look at the SPY IV. This is for zero DTE. This is fixed strike zero DTE IV. And this is the index IV. So remember, we went over the difference, right? Again, I'm recording the SPX, right? I'm recording the expected move, which is given to us here on the option chain. This is the expected move. And then we have the fixed strike for the vol for this, excuse me, that's not fixed strike. This is the vol for this tenor, right? So this would be term structure. This, this, this creates term structure, right? That's the term structure chart. Inside here, the implied vol is from one option to another. That's going to be your implied vol skew. All right. So back to here. So we have an implied expected move of 40. And again, as I record this every day, I'm learning myself that this is rich. So I'm saying to myself in this morning, which is why I was a little bit disappointed that I didn't buy this. I'm like, all right, so I know that there's premium asymmetric, and it's the play is going to be they're going to want to harvest this in the morning. We got a bullish CPI number. So just from looking at this and knowing that the VRP is rich for zero DTE, right? And knowing that the CPI is good, and then you come over here and you see this premium skew, right? Where we have this fat put skew and this cheap call skew. That is a buy right off the open. Buy. All right. Um, quite frankly, though, being that it was not in zero DTE, and it was one DTE, this is a nuance. You guys are just going to have to kind of follow this stuff and you'll pick up on this stuff, after a while. It just really threw me off. And so I didn't get long. And I even, I expressed it. I said, I made a mistake, right? I guess I made a mistake. And if you see in my notes right here, I said it right here, looking rich. Back to what we were talking about in the beginning, right? Is skew asymmetric? What are the large traders going to do, right? So we're expecting some bullish price action in the morning, and that's about as close as I get to predicting anything. I just look at this scenario and I say to myself, that's what's going on. But guess what? I also said, right? Because it's a conundrum, right? Because we're like, wait a second, the VIX is looking cheap, right? So we have a scenario where it's like things are a little bit mixy here. So I'm alerted to there's a risk. And that's why it's so important to understand when I separated the difference between the VVIX and the VIX and the SPX and its IV, but then also the SPX to the VIX, which is these are all different dynamics, right? Um, and so it's really important to understand the difference, right? So let's go now and look at our chart and see what we have and how this um, let's look at how this plays out side by side. So if the expected move is 40 for the day, according to the straddle, all right, let's go over here. 67. Let's really just make sure that this is robust here, right? So we got 38. This is at 67. All right, so 68.15 is my TOS expected move high. Okay. Then I also go ahead here and I go like this. And I say this is plus 40 from the open, right? And so here's my expected move high for the day. And so again, remember the bell curve. What happens when we get to 1 and 2 standard deviations? The play comes in, traders sell these calls here, they buy puts, right? This is a very famous play that guys do with the low a day, get to the low a day, they will um, sell puts at the expected move low and buy calls, right? Because the distribution says that 68, almost 70% of the time, we should stay within the expected move, right? And so let's also go ahead and go and give us the low for the day, right? So this one is going to be, right? Okay, so this was our expected move, right? And so we did end up staying inside of it, interestingly enough. And so if we look at the straddle, okay, the straddle sells off. And so that tells you that we're more than likely not going to break out of this expected move, more than likely, because the straddle is selling off, right? So the EM is shrinking. Right now it's 35. Okay, can you guys see this? Zoom this in a little bit more and let me make these smaller for you. So the expected move, right, opens up here at 40. This is the straddle, and we see it respecting VWAP, right, selling off, and we get to one standard deviation of VWAP. We get to this RSI 30, which could be oversold, right? And we see this pop, okay? And so that pop corresponds with this expansion right here because the EM was shrinking and it got down to 35, right? So the EM got as small as 12, 68.12, all right, which is here, right? Right here. And so the straddle is telling us now, wait a second, we're pricing in a larger move for the day. So this fall expansion, this expansion in price for the zero DTE straddle is telling us now that this distribution is widening. And so we can expect a wider expected move or normal distribution for the day. And this is dynamic. This is going to change. This is why I like to watch the straddle. And you'll see me in the Discord all the time calling out, straddle is 50, straddle is 60, straddle is 70. And then we have that high, that straddle 70 high. And then you see the straddle start selling off. And so now we have our distribution for the day. 70 is the EM high. Sell your calls, right? Buy your puts. And so while the straddle will lose money after that, why? Because we're staying within the expected move. So you could sell a straddle up here, right? And at the money from the open straddle up here, right? And it loses money, right? It was almost $50. Look where it closes. 16. Okay. So that's an awesome, awesome trade for guys that like to play short straddles. Again, you're going to need a big fat account for that and a cool broker, because your risk is unlimited on either side, right? What are the chances that this thing just completely dumps and your short put because of a flash crash just takes every penny that you have, right? Could happen. It's happened before. So and just an idea, right? How could we mitigate that risk? So you could go ahead and this will help you with your margins also. So we can come over here. I had it on SPY, pardon me. Come on, think or swim. Thank you, sir. Okay. And so what we could do is we could grab our straddle, right? But before we do that, we'll come over here and we'll just grab some protection, right? So, and you could do this for cheap. And this is for margin purposes, all right? This is not for like real life risk. This is for margin purposes. And so if the world ends, you don't lose all your hard earned money. If we're trading 68.30, you could just buy a 50 cent put, all right, 100 points down. And so if you have one short straddle, right, then you could go ahead and buy like 100 points up call, and you could, which obviously the right tail is not going to be that ferocious. but the left tail sure as hell can be, right? So when you just throw that little protection on, that's going to drastically change your margin requirements, and that'll allow you to go ahead and trade that short straddle. But you're going to want to do it first. So go ahead and buy a cheap $50 put, buy yourself a cheap $50 call, and go ahead and short that at the money straddle. And now you have a defined risk where the risk is still wide, right? Because if it all sold off, you're gonna eat it for 100 points unless you get out of that thing. If it happens in a flash, you're down 100 points. It's like 10 grand, right? So you're gonna eat that. But for the sake of margins and for the sake of just putting on the trade, realistically, you're going to want to delta hedge these normally anyway. That's a little bit of an advanced concept. Um, but yeah, that's how you can go ahead and play that. And so every day when we watch this straddle, if you want to know, like, what is the market going to do? Like, what is in the scope of possibilities? Like, what can really happen today? And I see people that'll be like, oh, we could trade to 68.50, and say we're trading like 68.20. If the expected move is 68.20 and that straddle ain't breaking out, well, guess what? We're not seeing 68.50, guys, right? Because the straddle is not breaking out. And that is an awesome way to use the straddle to manage your expectations throughout a trading day, right? Let's go ahead and look at Friday's straddle. And so we opened at 67.90. So let me go ahead and change this to 90 again. We can do volume profile next. I mean, I have a blown out leg from training Brazilian Jiu-Jitsu. I tore my calf, my quad, my hamstring, my groin, a little bit of my glute. So I am literally in a like flexible cast, and I am like bound to a chair. So I'm not going anywhere. So, when we're done, if you got time and you want to jump on, I have no problem going through charts. Yeah, dude, it sucks, and it's already been like 2.5 months, and so I'm going to be sitting here for at least another 3 months. I'm lucky no surgery. But my leg is like the size of a tree trunk. It looks really, really weird. And all my friends that see it are like, dude, what is going on? And I'm like, yeah, dude, it sucks. Well, you know what? I'm all right, right? So I'm just letting you know that I'm on the screens, right? So take advantage of it while I'm here, because I know a lot of guys are, riding dirt bikes today and doing all the fun stuff on a Sunday, and the guys that are here are serious, and they're, trying to make some money, and I respect that. And so I'm here. And so, we could go over whatever we want, right? But so let's really examine, like, were we ever really going to trade 68.50, this day? Like, I had lottos on, like, I'm not going to lie. I really actually kind of traded poorly this day, to be quite frank with you. I caught a decent short here, at the end of the day. And so let's talk about. Hey, Steve-O. Yeah, I'll go ahead and I'll post this in the chat, and I'll probably go ahead and officially make the YouTube. I suppose it's a big responsibility to be making videos, but just for the sake of having something up, I'll probably throw it up on a YouTube, right? So, what was the situation coming into Friday, right? Um, let's go back to my market monitor and let's see what Friday's temperature was for the 19th. All right. So remember, we talked about value, how we opened inside of value. That's where we were trading pre-market. We looked at the straddle, which was kind of big. We had similar IV again, right? So again, we're looking at like a semi larger straddle than normal. We're looking at a 26 IV for 0 DTE. And quite frankly, this is usually like a 20 or an 18. So at a 26, when we're realizing, a 10 vol, which is we've been around that area. We've been like gyrating between a realized vol of 5 and 10 recently. So a 26 is a fat premium. So these guys are going to come in and they're going to sell that. And what does that make? Bullish drift, right? What else do we get at the open here? We get a break in our linear regression channel, right? We go ahead and we open outside of two standard deviations. This often leads to a breakout. What is the value in checking the XSP versus the SPX? Well, it just lets you know where everything is because you want to just have a general idea. Sometimes they're different, believe it or not. Um, so just recording all that stuff, it just gives you like a real broad picture. I'm going to be honest with you. There's not as much VRP in futures. You know what I mean? So it's just something to to kind of take note to. So when I do this every morning, I trade all of these. I mentioned a little bit earlier briefly that I don't trade SPX options in the morning just because they're so expensive. I'll stick to the SPY because I like to have a couple of them, you know what I mean? And I like to have something to sell. If I buy five of them, I could offload two. And that's how I like to do that. So really quick, I want to go back to this slide, right? How to trade zero DTE options, strike selection, right? How to roll these puppies. And this is a huge mistake that I see traders make. And so I want to touch on how to roll and trade zero DTE options properly, really fast, while we're talking about this, right? Um, and so really fast, I'm just going to use like, uh, we could use this day as an example. So here's a 2 minute chart of how this thing breaks down, right? And if you were to look at my orders for this day, okay, you would see that I took a core position that I intended to hold. And I wasn't going to get out of that until it stopped me out. So it could have been a loss because I don't know what's going to happen. So I have this one position that I put on, right? Um, I believe actually this morning it was an SPX put because I was super bearish. And then I go ahead and I trade around that core short with lots of SPY puts. And so if you notice, we get this spike, right, down to here, and then we reverse, and then we get a spike down to here, and then we reverse, and then we get a spike and we come down. You can make so much more money right here by rolling those, okay? And listen, it's difficult. Yep. Take care anytime, guys. So you can make so much more money by rolling your options than just holding them. And you have to remember that there's a theta aspect, there's a vega aspect. And so that initial shock down, okay, from failing up here to getting down here, by the time this option gets rolls all the way back down to this level, it may not even be as much as it was at this level. And that's the weird part about like zero DTE options. So if you held this thing, right, and you got short up here, there's a chance that if you're sitting right here, you're at a loss right now. All right. It's a weird function. And so the true way to trade these puppies is to roll them. Okay. Yeah, theta decay is absolutely real, but also the expansion of volatility and the mean reversion of that volatility is real also. So you have two things against you if you don't roll these guys. All right. And so what we want to try to do is, okay, realistically, are you going to catch this? I'll tell you right now, this was a one standard deviation. So when we got down here and my premiums are exploding and I'm looking at my P&L and I'm up $700, right? Granted that I'm already short, I'm rolling that. I'm closing the trade. Because why? Because I see this thing stopping. I'm getting this tail. I'm closing it. Boom. So now I just locked in that profit, right? And then what happens? We get this dump and it comes back up. Okay, so if you miss this roll right here, there is time. This is 2 minutes. This is like about 10 minutes in between this. So you have time. It comes back up to this level right here. You have time to grab those again. Okay. And then you get this boom come down and it comes up again. Right. And so when you're in here, you're going to see this crazy change in your P&L. And when you get this punch down to right here, your P&L is only going to be worth what it was right here because this initial expansion is going to give you that real expansion in your P&L. And this rollover that wasn't so violent, you're going to end up with a situation where your position's only worth what it was right here. Okay. And so when you're seeing this stuff play out, you want to roll at the breaks. Okay. And this is a really cool study that we did. This high of day, low of day study. And I'm going to pull this up and I'm going to show you how cool this thing is because what it really does is it also highlights the turning points in the market and when this thing is likely to take a breather and bounce. So every 10 minutes or so, right? We have the propensity to bounce. These are when the market makes lows in the morning, right? Look, 9:40, 9:50, 10 o'clock. Let's check out when the bounces are. 9:35, 9:40 corresponds. 9:50-ish, right? These are all turning points, right? So like every 10 minutes or so, you see these things bounce, right? Here's your 10 o'clock. Okay. Let's go back to this chart. Here's your 10 o'clock, right? So this is timing the market. I hope you guys all really just immerse yourselves in this chart. And I actually have a poster of it up on my wall that I had printed out from Staples because it's so significant to understand the timing of the market. And I never see anybody talking about this stuff. You know what I mean? And it's so true. So when you're rolling your options, right? You want to be covering into this downside move. You want to be taking your profit. If you have a core short, okay, cool, leave it. But then when you break here, right, you want to be, again, taking more short puts. When you're getting this kind of spike here, you could add on that spike. When you get this right here, if you wait until you come down to this level again, you're losing a ton of money. Um, if you are entering and exiting the put swings, are you just hitting the ask? Yeah, absolutely. I really do market orders, and so I do something really kind of cheesy, if you will. So let's pretend like this is a ladder, and so you have the offer and you have the bid. If you're on if you're on interactive brokers, they have this thing called smart logic. And so that's where I execute. So if you place a limit order above the offer, it's going to go ahead and it's going to fill you at the midpoint immediately. So it's essentially a market order, but it stops me from getting filled above the offer. And that's just literally like a hack or a cheat code that was given to me from the gentleman over at Dash Trader, which is a really awesome professional front end for traders. It gives you direct to market access. You could pick your broker. They'll sit there and write algorithms for execution for you. So you call them up on the phone, you get on the chat and you say like, hey, I want to be able to click a button and I want to get into the market, but my broker is giving me these crappy fills, and they suggest we're going to give you a marketable limit order, it's called. And so what that's going to do is it's going to automatically, you're going to go above the offer, and that's by law is going to fill you at the midpoint. So it's a hack. Um, so Cool. So Charles just shared that you can actually use that same methodology here on the active trader. So that's how I'm getting into these trades because I just want to get in. No, I don't, because the logic is that when you click that order, it's getting sent right to the midpoint. It's a marketable limit order. We could dive into for like a quick second just order routing and how that really works. So your broker is going to take your order when you put it in, if you go to the market, and it's going to really fill you at the midpoint for like the future. And so you could end up, if I like market orders, like I just want to get in. I'm really not nickeling and diming as much as I just want to get into the market. So limit orders, there's actually really no such thing as a market order. All orders become limit orders at the exchange, but limit orders they're called marketable limit orders. So a true limit order it means that if you put in a limit right here, okay, and nothing trades there, you won't get hit. So if you're on the floor and I say back in the day and I say, hey, I want to put in a 68.34.50 limit to buy, and the market doesn't trade there, it just goes straight to 35. Well, guess what? My limit gets missed and I don't get hit. And they say, sorry, buddy, 35.50s didn't trade. 34.50s, excuse me, didn't trade. And I don't get filled on my limit. And so for retail brokers, in order to prevent that from happening, your limit orders are actually marketable. So they become market orders. And that's a inner function of order routing. And I had tons of headaches to figure this out. And again, the guys at Dash Trader really explained that order routing dynamic to me because they're in order routing front end. Um, and so that's how I get into these trades like super fast. I just want to get in. I'm clicking to get in, right? And so again, when you have these breaks in the market right here, you get this expansion right here. Um, yeah, for sure. I will actually definitely share that with you one day. Just remind me, Shorty. Just remind me, and I'll share that with you. Because putting your order in is actually it's a nuance, but it's super important, right? Doing that correctly. And so what you want to do is you want to recognize that in this little area right here, let's say that you want to be selling high and buying low. If you do choose to buy an option at this breakout, your only point of profit is going to be from here to here. When this meanders, you're going to be at like a break even, okay? Or maybe down $5 or something small until you get this expansion again. And quite frankly, your P&L may literally be what it was at this expansion. You know what I mean? So you want to be actively, when you see your P&L explode, cover it, roll it, cover it, roll it. And I stick to at the money options. Why? Let's go back to that gamma chart that I shared with you guys because gamma and vega, actually, let's just do this. This is really cool, right? So let's run down here. So here's gamma. And this is zero DTE options, right? So gamma is greatest for at the money, right? This is what spot gamma is all about, right? This at the money gamma, right? Let's look at Vega, okay? Vega, greatest for at the money options. So what is Vega? Vega is the rate of change for delta for a change in implied volatility, right? And so gamma is your rate of change to delta also. So these are the two Greeks that are going to affect the rate of change of your deltas, which is your P&L, right? So you're going to experience the greatest expansion of P&L at the money. So when I'm rolling my options, okay, I'm not rolling them in the same strike. What I'm doing is I'm rolling them into the next strike at the money. If we're trading down, then I'm now trading 15s. When I roll them, if we're at 90, I'm now trading and rolling into 90s. Okay. And it's really important to understand that when you roll options, okay, it's going to help you, especially on a bullish day, because during implied vol crushes without a spread, right, you're going to be losing money. So if we didn't roll our options on Friday, you can see that gamma value in the option chain data column. Yes, you can. Absolutely. I was just, and that's going to be right here, your gamma, right? And so I just wanted to, and honestly, TOS's Greeks are a little bit sus. I think Interactive Brokers who use ORATs actually has a little bit better Greeks. But again, the actual, your delta is important. Do you need to know specifically what your gamma is? Unless you're delta hedging, you really don't. Um, what's my execution time frame for rolling options? Uh, my execution time frame on rolling options. What do you mean by that? 5 minutes? Yeah, I usually like a 2 minute chart. And the reason that I like a 2 minute chart is because it really gives you like the inner ups and downs. I like a 2 minute. I like a 2 minute. If the 2 minute gets choppy, right, I'll jump out to a 5 minute because sometimes that 2 minute can definitely get choppy. And so here's what a 5 minute chart looked like. What day were we on here? Oh gosh, we're in November. Excuse me. Knew that wasn't looking right. Okay. And so on a 5 minute, I guess TOS needed to load that. And so here's a 5 minute. When do you cut your losses if price action just stayed put like 15 minutes, depending on price? I get out fast. Like when I tell you I get out fast, I get out immediately because when I buy an option, when I put on a position, I'm looking for this thing to move like pretty quickly. So unless it's a situation like I'm up here and like, upside is limited because we're at the expected move and we're also at the SPY call wall and I'm looking at the straddle and the straddle is not expanding, then I'm cool with sitting in puts up here. Um, but I'm also not going to be sitting on that like all day long. And if we're trending up, like I'll roll the put up. I'll roll the put up for protection. But if you look at a 5 minute chart, you know, this is like a little bit choppy here. So the 2 minute, I think really just gives you the best. Um, I think the 2 minute really just gives you a clearer picture. Uh, where we were on this day. Sorry about that, guys. This was the 15th that we were looking at. So I'll go back to the 5 minute. This thing's going all over the place. I hope I'm not confusing you guys here. And so here was a 5 minute chart. Okay. And we went over this a little bit earlier, Ghost, where on this day, one of the signals that we actually had on the 15th was I shared it. If you scroll up in the chat, you should be able to see it. I shared two charts of Trace um, on the 15th. We'll go back to Trace really quick for you. And so what we had here was these guys closed their straddles. So we have a short straddle. We have a short straddle, right? We have in the money short puts. We got long calls, right? We got short puts above the market. So and we have short puts like at the money. So this is really bullish positioning, even though we get this dump at the open. But what we have here by the 940 update is they close those straddles. So now that means that the expected move is going to get violated, right? They're no longer saying that I believe that the 9 o'clock expected move is going to hold. So they close their straddles. And so that 940 right there is going to help you to sell these pops and stay in your short from the open. And then I went ahead and I'll give this to you as also Ghost because we were using tech as an indicator for the 15th. And so we saw that tech sells off in the morning, right? The last man standing on the 15th here was Tesla. Okay. And so if we're just looking at this 2 minute chart, you're probably saying there's no way that this guy is rolling these things like this. It's too much to sit there on the chart alone and do that. And you're absolutely right. If I was just sitting there on a 2 minute chart, there's no way that I would accurately, profitably be able to roll those options like that. But I have a bearish stance because I see that on my tech sector chart, right? Tech is dumping. And I know that the last man standing is Tesla. So anytime that I'm getting that price expansion right here, boom. The second that this candle turns green, I'm rolling it. I'm getting out, period. I'm closing my trade. I will get right back in, and I mean immediately. And it'll be right here. So I would have been short. And again, I trade SPY in the morning, right? So I put on a core short in the morning. I actually put on a SPX put that I held throughout the day. So this was an insane day for me. And that was like, that could get stopped out. That's my core short. And the reason why I'm aggressively rolling these other positions is because I want to lock in profit. This happens all the time where we get this, right? And then tech turns around and this bounces. So if I just put this one short, this one long put, this one short on, and I wait until I'm stopped out, I miss all this juice. So I'm rolling these, rolling these, rolling these. So if I get stopped out on my core short, guess what? I'm already up one or two, one or two daily goals, which is like 500 bucks. And so I'm saying to myself, like, okay, soon as this candle turned green right here and this wasn't working out, I was taking profit. And then when this came down and I see my P&L expand again and this thing turns green, I'm taking profit, right? And then I see this and I get this little pop and come down, I'm getting short again. And so I'm actively rolling these and I'm going in. Now I'm using at the money options, right? So I'm going to trade either the 685s or the 684s when I'm right here and I want to get buy puts. Typically, I really want to use at the money. So it's going to be the 684. Okay. If it happens quick, I may stay in the same strike. But that's only going to be if I don't have time. And maybe I made a mistake rolling, right? Maybe I saw this candle turn green for a second, but then it starts turning gray again. And so I may just get right back in. Okay. And then I'll manage that position actively while in the background, I'm short. What does it say? You are buying long options at the money. Once it moves in the money, you roll the current at the money. Exactly. You're using price weakness to trigger the roll. Yes. You have made a comparison to what P&L would be with this method versus holding the long position until the reversal. Yes. If I took this short right here, meaning a long put, okay, when this pops up to here, even though I have a bit of P&L right there, right? It's not going to be the case. You're going to be down or at break even. Okay. And when this comes down to here and we get this little spike, that's going to be your max P&L for this move. And so the second this thing turns green and looks like it's going against me, just because I don't know what's happening. Again, this could reverse. This could be the low of the day. This is 930, right? 934. Look at our low of day chart. So this is big reversal low of day times, right? So I got to be careful there. So I got to lock that profit in. Okay. You aren't rolling them in one trade entered through the broker. You are rolling them manually. Yes, that's right. I have my active trader ladder up, and the way I have my window set up on Interactive Broker is I have my ladder here, and I have my option chain here. Um, Another way to do this that when things are moving fast is I have a hotkey, and so I'll go ahead and I'll pull my option chain off. So I'll detach this window. And so I did it wrong, but this is going to be my option chain and I'll have it next to my ladder. Again, I have a couple screens. So on my execution screen, I have the ladder and I have the chain. And so really fast, if I want to roll, I can just hold shift and click the strike. And I don't have to deal with any of this stuff. It's just going to get me right in. And if I want to get out of it, I just go ahead and I click the bid, hold shift and click the bid, and I'm out. And so that's going to enable me to roll and change strikes really fast because if I want the ladder to populate, I'm going to have to click this and that's going to populate a change in the ladder. And that's going to take about 3 seconds and that's going to slow me down. So a lot of times I just trade right on the option chain by just hitting the offer or hitting the bid. Okay. And so coming back to and so that's how I'm trading these things. And so on a 2 minute chart, and again, um, the reason why I was so aggressively rolling these short is because look at tech. And again, remember we went through what tech looks like. It's different. Really quick, let me just pull this up for you guys. So here is a high and low cluster chart for NVIDIA. So we see that tech could make a turn in this first like hour, right? So I know if I'm rolling these shorts, I need to take profit aggressively and I need to get out of them quick. There's plenty times where I get out of a trade and get back in immediately, right? There's nothing wrong with getting out and getting right back in. So, but I want to lock that profit in again because if this does reverse and my core short gets stopped, I don't want to be up $700 here and letting this meander. I want to take that. So now I just locked in 700 bucks here, right? And then I got a chance to roll again, and you could see This is respecting, this is a 10-day. I put this 10 period simple moving average on a 2 minute time frame. And again, it means absolutely nothing. Nobody needs to do anything at this, but price respects it. And so these are great places to roll just as a guideline. You know what I mean? Nothing has to happen at these moving averages. They're just guidelines. Like, look at this failure. That's a rolling opportunity, right? Look, if you miss this and you get that pop up into this, right? Look at this overnight level and you see that dump. Really quick, I want to point something out that happens in Thinkorswim, and I use these directionally. The presence of this right here is alerting me that we're going to see downside price action. If I see this to the upside, that's alerting me that we're going to see upside price action. Why? What is this? This is somebody coming in and selling a ton of spot pre-market where there's no volume, and they're getting filled all throughout this whole entire thing. That's what this is representing. Okay. And so whether this is a mistake or some type of a charting error, they are actually oddly accurate. And so when I see this post market, I'm like, all right, so I'm expecting some downside price action. This is another clue. You're not going to see this on SPX, but you will see this on the Qs and you will see this on the SPY. Okay. And so another way this morning, back to my main chart, using the Qs as an indicator, right? So I showed you the internals, so you could set that chart up the same. But look at where's 1219? What are we talking about here? This is 1215. So on the Qs, let's see what was going on 1215. I can't tell you how many times the SPX chart looks bullish, right? And the Qs are just doing this. You know what I mean? Look how identical it is. But there's times where there's a major divergence, and these candles are just showing you the residue. When you're watching this live, you're watching live tech weakness, you know? And so this chart right here, the Qs, is broken down internally. And so I could see here that tech is super weak. This is the inside of that Q chart. And so when Tesla rolls over here at 945, right? Where are we? This is 945. Now we're getting this follow through finally. Okay. And so now you're going to see this thing really fall apart. And so that's how I'm rolling these options. Let's go ahead and look at Friday, a day that we had some rich VRP, right? And so when you're getting long at the open, you don't know what's going to happen at this spike. You don't know. So you want to go ahead and cover that and lock that in. You get a dip, right? You could go ahead and say, what's tech doing? Do I want to buy this dip or do I want to sell this dip? Guess what? AVGO finally ripping, right? Look at these guys. They're flat to ripping, right? So that's all we need. And this was a little bit mixed in the morning with Tesla. So, but we had other factors that gave us clues that we were going to see upside price action. And that was again this at the money 0 DTE IV being a little rich, because if I was to pull these up and show you what they are typically, they're usually not in the 25s. They're usually more like 20. They're usually more like 18. And so that's a little bit rich. And so guys, when they harvest that, that's going to give us a bullish drift to the market. And so using my dashboard here, where I'm seeing VIX just absolutely getting hammered, right? And I'm seeing AD kind of just like meandering, and tech is like, you know, not falling, right? So it's not it's not going to get murdered. It's holding, which is all we need for the SPX to do what it does. And so now I know that I want to be rolling bullishly. I'm not looking for a reversal here because I have this VRP aspect, right? This purple line is VWAP. So we hold VWAP, right? We bounce. Can we go over VRP and how to get it calculate? Yeah. So VRP is the relationship between IV to realized vol and or historical vol. And so on this chart, where are we? Interactive Brokers gives you this classic, and if you scroll up, it's in the chat. I'll go ahead and post this again. So this is like your more classic historical vol to implied vol chart. And here is our spot gamma skew chart. Again, this is vol skew. This is not premium skew. So there's a difference. So we know that, and this is for Monday. So we see that we're in this we're in this area where vol is cheap and you do want to look for vol expansion, right? But we talked earlier and mentioned the many different types of skew and vols that there are, and the difference between them. And so we want to recognize that. And so a way to do, you're going to want to, it's a very complex formula to do realize volatility. And so you could just take AI and you could just say, hey, make a script, a .py script, and say, what is the realized volatility for the last 5 days in matter of fact, while we're sitting here, what I have in the morning is I have my scripts that I run, right? And so I pull up my Anaconda prompt, right? And I'm going to do another one of these and we'll deep dive into using AI and how to really use this, right? But I got to go to my source folder, which is right here. So now I'm in my source folder and now I have my script that's going to give me the IV to RV relationship. And so I go ahead and I type that in, enter, fetching data. And now what I have is I have this 5 day rolling relationship between VIX implied vol and realized vol. And I have this rolling relationship between SPX implied vol and realized vol. And then what I want to do is I want to monitor the spread because the spread is what these guys want to capture, right? So we're looking here and we see that for this week, okay, this was the 5 day realized vol every day. And here was the IV for the morning. So you could see here there was about 6 points they got on the 15th. Not so good, right? Why? Because 15th was we viciously sold off that day, right? Um, and so when this spread is small, uh, then you're going to be looking for like a vol expansion. But if you come in the morning and you happen to see that the VIX, VVX, so that's VIX IV, to VIX VRP spread is wide, that's going to alert you to the asymmetry in the VIX complex, which is going to greatly affect the SPX. Okay. I cannot tell you how many market bottoms. I'm talking 2020. I'm talking the most recent 1120. I'm talking about um, every significant market bottom. It's not some guy that comes on, Bill Ackman crying, that's the bottom, and all these trader hunch intuition things. It is the VIX to VIX IV spread cashing a check that it can't cash. Okay. Where does the script get data to calculate this? It pulls from Y Finance. So the inside of the inner workings of this script is that it's going to go and pull from Y Finance and it's going to run the calculations for me. And then so when I come in the day, how did I learn all this AI quant stuff? I got a buddy, a money manager named Charles from Texas that showed me how to use AI to code indicators. And I will absolutely, maybe we'll have him join on and do a really cool um, another presentation. And I think that a lot of people are using AI wrong. I laugh how many people are stuck in the browser version of I won't laugh. I mean, it's not laughable. But what's laughable is how many people use AI to say, "Hey, why is the sky blue? Why is my tongue red?" And instead of really using this like, how it's supposed to be used. So I have Claude um on my desktop and I have a folder sandboxed where I put all types of data, right? So I'll show you that really quick. Desktop, market research. And so here's our sandboxed folder, right? And so here's our data. And look at, I got all 1 minute data, 5 minute data. I got 5 years, I got 20 years, I got 10 years. And so I pull this from Sierra Chart, which again, for 150 bucks a month is like, you could add indicators to the spreadsheet and you could say, hey, give me 10 years of data and for 1 minute bar and volume, but you could include VWAP, you could include RSI, you could include stochastics, you could include moving averages. And so Sierra Chart is worth its weight in gold for 150 bucks. I really suggest that people get it. Again, you could pull from Y Finance, which is quicker because you got to remember, let's say that this is only until like I did a study right here for ES continuous for 12/9 from 2020, only going to November 14th. So I would have to repopulate that data to get it like up to date. So depending on the study, every morning I don't want to do that. So I'll just have Claude, my script, pull from Y Finance for that. Excuse me. And so that's how I will use Claude to, and if you we could again get into this in other times, but if you go into, remember, everything is open source. It's not copying. This is meant to be built on. So when you come in here and you click on here, which is the script, you're going to get the inner workings. And so how did I code the reverse RSI indicator, right? I would like for everybody to think I'm this incredible genius, but I mean, I'm really um, just being a little bit resourceful because I have here the reverse engineered RSI. Okay. Um, and so what that does is it just gives me RSI 50. And I'm like, man, this would be awesome if I had the bands on here. And so what I do is I come in here and I click this, I copy it, I paste it in Claude, right? And I say, hey, can you please, I always talk nicely to my AI so it doesn't sabotage me. Can you please add um, RSI 30 and 90 bands to this study? And in about 2 seconds, it's going to give me a script and I'm going to copy that script and I'm going to paste it. I'm going to go to create. I'm going to click paste and I'm going to name this my study of choice, right? And now I have my proprietary indicator. And for you guys that are intelligent in your own ways, you guys can go ahead. Claude says that you are out of memory deposit. Yeah, I know. Tell me about it, right? And the AI is not cheap, which is why I say if you're using a free version of an LLM through a web browser, you have to understand how expensive it is. Think about these AI companies and their capex. You got to understand that you're just not going to get the full potential out of what they're giving you. You're really going to want to, just pay an extra couple of bucks. Pick one. Claude is the best in my version, in my opinion. And then so you pay a couple extra bucks, and then they may charge you for extra tokens if you need it, or whatever. Do I run out of tokens? Yeah, from time to time. But for the most part, I pay like $100 a month, and it's not so bad. And so that's how we could use AI to derive these studies because every morning I need this quick. So I need to come here and I need to get this study like fast. Um, and so again, I want to just point out, thank you, sir. And so I want Charles has about 40 years. He was doing this when chart books, when he was getting chart books, and he actually ran a signal service through faxes. So Charles knows OG in this stuff, and he's helped me out greatly. Thank you, Charles, for all your help. And so so this understanding this relationship, when people talk about, hey, like what is the market going to do today? Thanks, Charles. When people talk about what is the market going to do today, right? Let's not look at let's not I mean like yeah, okay, charts and everything, right? But what happens in between, um what happens in between point A and point B, and how does it get there and why? So the collapse of the spread VVIX to VIX point to the market to be a point of going down. Ah, thank you, sir. Okay, so here actually on my slide, the last part that I wanted to really bring up was, so this is how we're going to spot um, a bullish drift, right? If we have this rich spread in the market, asymmetry, and we know that these, because Ghost, in the beginning of this, and again, you could replay this, we talked about Dodd-Frank and the restrictions that that put on banks in terms of holding risk and market making, and how these boutique smaller market makers came into the market, and they're filling the void, which is this systematic vol selling funds, and how that dynamic post 2010 has led to like long-term suppressed volatility. And we have spot gamma, right? So what is spot gamma? Spot gamma says that, what's moving the market, right? Dealer hedging is moving the market. Absolutely 1000%. That is correct. And it is so potent. Okay. But why are these guys positioned the way that they are in the morning? Like, let's take it a step further. Let's overlay spot gamma with the reasoning behind the positioning. Okay. And so that reasoning is going to be due to the fact that the VRP is rich or not. That's going to give you, that's how these guys are positioned in the morning. When we see trace positioning and there's a ton of short options and you see short puts above the market, that's going to be because this VRP is rich. And so these guys want to soak that up. And what does that give us? That gives us bullish drift higher. Now, let's get into the short signal, right? Vol expansion, okay, and how we could detect that. If we really quick just reference this slide up here when I talked about VRP. Um, anyway, we I can't find it at the moment, but we want to predict where that thing can snap. Okay, that's what we really want to predict. Okay, and so how could we predict where that snaps? And so what I have here is a bunch of charts that I saved. Where are we here? Excuse me. Give me 1 second. Here we are. Okay. So the collapse of the spread VVIX to VIX point. Okay, so here's to your question here. We want to spot the snapping point, right? So I include this in my script that spots the snapping point. And if you guys remember going into FOMC, I was like super bearish. I was telling everybody that I just don't see this thing rallying, and unless we had a super dovish Powell. All right. And I'm going to give you guys right now a super treat. Thank you, Ghost, for actually bringing this up, because this is going to give you a clear picture as to how I hedged this day, how I was wrong. I was 100,000% wrong, and yet I still made money. Okay. And that's what's so cool about options and option positioning. And so let's go back to, I believe it was December 3rd. Was this, when was, 12:10? Okay. Thank you, sir. Okay. So let's add, so this is what the skew looked like. Let me get rid of this one. You know what? I wasn't actually prepared to give you guys this lesson, but since Ghost brought it up, I think it's a really good opportunity to show you how I played this. Okay, thanks, Deval. Yeah, I mean anybody that could stay, hang out. If this is going long again, this will be recorded. I'm just going to go over this for Ghost really quick.